Hey guys, you're welcome back to my channel. In my previous video I did a tutorial on market structure, and in this video I am going to do a second tutorial. This is part 2, the continuation of part 1, which was market structure. Now let's step it up. Advanced market structure goes deeper than just spotting trades. It's about understanding what the market is actually trying to do. And now there are different method of approaching the market, different strategy out there, but this one strategy, this advanced strategy, goes beyond just break of structure, change of character. It is a little deeper, so I will advise you to get your pen and paper to write it down, because we're going to do a practical class today. So this is deeper. I mean, it's really deeper, so you will want to pay attention to grasp everything, because in this strategy, this advanced market structure has to do with a lot of detailing. Now let's begin. Before I come back to the chart, I'd like to show you some quick examples. Advanced market structure. There are 3 types of advanced market structure: the swing structure, the substructure, and the main move. These are where everything happens in a given market range. Now pay attention closely, because these 3 types of market structures, they all work together. What is a swing structure? Swing structure is when market breaks structure. The point where the market starts and where it turned is a swing structure. Example, like I have on my screen right now. So take for instance, market is on uptrend and this is the starting point, and it breaks structure. As it breaks structure and turned, from here to here becomes the straight structure. So where it turned, where it start and where it turned, this is where it start and this is where it turns. So where it turns becomes the swing structure. Now look at it here clearly. So you see it starts from here, and it breaks structure. The moment a structure breaks, you mark here and here. So this is your trading range from here to here, and this is your swing structure. Now as soon as market breaks structure and it turned, that's a swing structure, right? So you see the market comes down. It comes down and breaks structure the second time. This automatically becomes your swing structure. So break of structure and second break of structure, and then you mark here as your swing structure. This is where you're going to wait for market to take out before you take any trade. So let me go to the chart and give you a more detailing example. So before I show you this chart, let me tell you what I mean. So see, this is where the market starts. This is a move, right? So what you're going to be looking out for is, you're going to be looking out for something like this: a sweep, a break, structural liquidity, another break, then it comes back here. Here becomes your entry point. Then this is where you enter. So this is a sweep, a break of structure, structural liquidity. This is structural liquidity, and this is the main move. So as soon as the market creates structural liquidity, breaks structure, and come back to take it out, as soon as it takes it out and hit the next zone, the other block zone, that is where your entry lies. So this works well on a higher time frame, daily, 4 hours, and at times 15 minutes, but it works best on higher time frame. This kind of setup is best for swing trade because it doesn't hit TP quickly. It can take 3 to 5 days before TP can hit. So all you need to do is to keep checking your charts every time a market land. Let me show you an example of what I mean. So you can see right here, Okay, the first example I have is here. This is a sweep, right? This is a break of structure which validates it. There must be a break of structure. Without a break of structure, it's not valid. So here is break of structure. So here is break of structure, BOS. Here's break of structure, BOS. So here is break of structure, BOS. And then you mark your structural liquidity, which is here. And then you wait for market to take it out. The moment that happens, you are in a trade. So you see, this market came, take it out, and it started selling, right? So, and your stop loss point will be here. The stop loss point will be here, while your TP point will be here. Even though you pass it, but for the fact that you pass it, it doesn't always happen like this. So to be on the safer side, here should be your TP. Yeah, I hit this low and equally hit this low. So in this case, this becomes your first TP and this becomes your second TP. So another example. Is this here. See, there's a sweep right here, a break of structure right here. As soon as you identify that sweep, you wait for market to break structure. So there's a sweep right here, a break of structure right here, and then you mark your structural liquidity, which is this one. And your stop loss zone is this, slightly above it. So this is where you are gonna be entering this trade, and this is your stop loss. Now the best way to trade this setup is by using pending order. So because you may not be there when it finally plays, but all you have to be doing your job every day is to identify this sweep, a break of structure, mark your structural liquidity, and then you set your pending order at that structural liquidity. At where the structural liquidity ends, that's where you're setting your pending order, and your stop loss is slightly above this high. Then once you're in a trade, your first TP is this low. So your first TP this low, second TP this low, third TP here. You see, it did not get here. So that's why once you're done with first and second TP, you're done. Then market continue doing other things. So I like you to know that this is a pure swing setup. I have a free trading ebook gift for you all, my viewers, and I equally have two other trading ebooks for sale. When you buy one, you get one. And these ebooks, they are top notch. So comment in the comment section if this setup is clear to you, or if you're gonna be using this setup, or you need more explanation. And that's it for me for now. Bye for now. See you in my next video.